Hi, Mark Anderson here, mortgage banker with Paramount Bank. I am licensed to lend in all 50 states, and I would love the opportunity to earn your business. Unfortunately, I had to take a few days off from doing these daily rate updates. My priority had to be with my existing clients and new folks coming into my world. I've actually, as I've said in previous videos, I've been really blown away by the response from these videos. I think I'm over 10 active clients that are working with me right now that met me through doing these videos. So I do think it's valuable. I do think that I've got something to say that I think that you'll find valuable. Today, normally what I do in these videos is I show you the relationship between rates and the mortgage bond prices. And what I said on the last video I did this past Friday is that my prediction was basically we're going to enter into a time period where the typical relationship between bond prices up and rates down, my prediction was that that was essentially going out the window, and to expect really the unexpected going forward as far as future rate movement. So what we've got, for what it's worth, is a picture of the last 5 days in the mortgage bond market. And you see incredible volatility. You see back around the time I shot that video, bond prices were at, I think, what is a true historical high price, which should, under normal conditions, have led to a massive drop in rates. And it didn't. Rates are still very low overall. Relatively, what we're talking about is bouncing around still very low rates no matter what you're talking about, historically speaking anyway. But what we would have expected to see under normal conditions was a huge drop at this point, and we didn't see it. This week, I really want to try to make the point that because we can't use traditional market indicators to tell us what's going on and why, as a consumer, I think that it is very smart to put yourself in a position where all you can bank on is today. I do recommend that if you're shopping around for a refinance, that you do talk to a few different people. And one of the reasons for that is the key driver for volatility right now has very little to do with bond prices. It has to do with individual mortgage investors and their appetite for new business, also their preference for the type of business. And I'm going to explain that in a little bit more detail here in a moment. What makes me and Paramount Bank somewhat unique in the industry, at least there's a class of lenders that operate the way that we do. We have what are called correspondent lender relationships. So when I pull an interest rate quote, I am not just seeing one rate. I am seeing many, many, many different correspondent investors, and I'm seeing their pricing. One of the interesting things about being in this position, and the good thing for the consumer, is that if I've got 10 investors that have really just priced themselves out of the market, well, those aren't the rates I'm going to be basing your scenario on. I'm going to find that investor that's still very aggressively priced. The beauty of correspondent lending is that I have total control over your customer service process, though. Although the servicing is going to be sold to one of these institutions, that's done after we close. So I have total control of originating your loan, processing your loan, closing your loan, and funding your loan, which is very, very nice. But what I see on the correspondent pricing is I see exactly the same type of phenomenon I've been talking about in these videos, which is the bond prices can be doing whatever they're doing. They could be very high. They could be somewhat lower than that. And what's actually changing these rates is that particular investor's preference and capacity and appetite overall. And so that's what's led to this just dramatic volatility in the market. Correspondent lenders and all the big banks are not shy about changing their rates really at a moment's notice many times throughout the day. It puts me in an unfortunate position, a position that's kind of frustrating from my point of view, and I know it's frustrating from the consumer point of view, because I'll be talking to a client and I have to basically tell them the rate that I'm sharing with you now is the rate right now. That rate could be different 15 minutes from now, half an hour from now. And until that lock order is actually executed and registered, we're all subject to this very quickly changing market environment. And so it makes it tricky, because what I never want to be is that fast-talking sales guy that bullies and convinces people to lock in because I want their business. But unfortunately, the way that the pitch goes, if I'm being honest, is, look, this is the rate right now. If you like it, we really need to get it locked. And if I don't have an existing application, that means I need to collect that information from you, and I'm going to need to enter that information in and register your lock. With all the volatility, there's always the chance it could change. Rates are subject to a constant threat of change at this point in time. Now, I mentioned something about lenders' preferences in terms of products. One group of folks right now that are really going to have a hard time getting rates anywhere close to the low points is anybody that's using a government loan program. So this would be your FHA loans, VA loans, USDA loans. The big institutional investors have made it very, very clear that they don't really want to do these loans in the level that they were doing them before. They have increased their margins dramatically, which means on a day-to-day basis, the difference between a government rate and a conventional loan rate, normally government pricing, honestly, is usually a little bit lower on the interest rate versus a conventional program. There's some trade-offs. FHA has rather expensive mortgage insurance, et cetera, that makes up for that rate differential. But FHA pricing pretty much across the board right now is higher than conventional pricing, which is kind of bizarre. The other thing that's bizarre, and I think this is very frustrating, is that a good number of the big institutional investors have said, okay, we're going to continue to do FHA loans. We're going to do them at increased margins, but we're just not going to accept, say, an FHA loan with a credit score below 680. The reason this is frustrating to me is that's kind of what the product is designed for. FHA is a very good program if you have a credit score between, say, 620 and 679. That's usually where you're going to find your best deal. But now the big institutional investors are saying, well, if credit's below 680, we just don't want that business, which is very funny because if you've got that 680 or higher score, you're very likely going to be getting better overall terms on a conventional loan. So that's just something to watch out for. The advice that I'm going to give to any borrower that's using an FHA loan, VA loan, USDA loan, lock in. There is way too much potential for these lenders to either stop doing FHA loans, continue to increase margins, et cetera. The rates right now, depending on who you're talking to, they're going to vary dramatically. If you talk to lender A, lender B, lender C, my guess is you're going to be getting a really huge range in those rates on those programs. Find the person you want to work with, and if they've got the lowest price especially, go ahead and lock that in. That's just a blanket recommendation. As far as conventional loans, what to expect going forward, I just can't tell you. I really wish I could. Rates overall versus last week, depending on the scenario and depending on the time of day, you may see pricing that's maybe almost as good as it was toward the end of last week. Some scenarios, oddly, I've seen actually priced out a little bit better, but it's just so volatile. I can't make any generalized statements about what the pricing is doing, and I certainly can't say what it's going to do going forward. I would be more than happy to talk with you about your individual scenario, give you an up-to-date quote. I recommend really we just go through it over the phone because it is such a fast-moving, fast-changing, and volatile environment. I would love to talk to you. Feel free to call or text me at the number below. Thank you very much for watching.